So good morning. We've had to change the schedule a little bit to fit everyone's schedule. So we're going to start at 8:45, which is now. And I'll come back, and Dean Almeida will come back and do a formal welcome in a little bit. But right now, we'll go straight to a fireside chat with SEC Chair Gary Gensler. And let's hope the technology all works. This is a virtual chat. There you are.
Hi, Rena.
Hi, Chair Gensler. Great to see you again. Thank you for joining us. And we are delighted to have you. You actually spoke in this room, you might not recall, when you were chair of the CFTC. So now you're here virtually.
I remembered, and I think I was kindly invited to speak at Georgetown a number of times, but I remember that podium. And I was also honored to speak at Georgetown just a year ago at faculty member of the law school, but Chris Brummer had asked me to speak about a year ago as well. So I'm glad to be back with Georgetown and glad to see you, Rena. For the audience, Rena joined us as a volunteer. We were all volunteering, but during the transition and giving some advice about all the financial regulatory agencies.
It was absolutely a pleasure to work on that transition team with you. And okay, so we have a lot of questions to ask you. Let's get started, right? So I'm going to try and cover three areas: market structure, digital assets, the crypto world, and ESG disclosure. Maybe we'll start with market structure issues. So tell me where you are in terms of payment for order flow, for example, right? Are you going to ban it or not?
So let me just step back and just put it in context. I think of our job at the SEC. Of course, we have a three-part mission about protecting investors, facilitating capital formation, and that which is in the middle, the markets, fair, orderly, and efficient markets. So that's our three-part mission. But we're very much, by Congress's mandate, a competition regime or competition authority as well, because in the old days of fixed commissions in the stock markets, Congress in 1975 inserted in our remit, and then again in 1996, that we had to address ourselves to competition and efficiency in those markets. The last time we updated our market structure, our equity market structure, was in 2005 and took a broad, one might say, holistic view. And I thought it was appropriate, and staff has been working on that. I gave a speech earlier this year talking about 6 different topics, but the core is how we promote greater efficiency. So that means using the tools of transparency. That means using the tools of access and trying to level the playing field in the markets. And staff is working on recommendations. They'll serve it up to our 5-member commission. And if I can't prejudge anything, then we'll put it out to public comment. So that's the broad remit. In terms of the pieces of it, as I discussed earlier this year, and you'll probably ask me more questions, there's really just in each piece, it's how we get greater competition, help lower the playing field, and as I think is try to get more order by order competition.
Yeah. So you didn't answer my question, but
ask it again. Ask it again then.
Would payment for order flow be banned completely or no?
Look, there's about 5 or 6 other jurisdictions that have done so, because there's an inherent conflict when the public is sending an order to a broker, and then the broker is selling that order. I think getting behind that conflict, what we're looking about is how do we get competition in that mechanism. So again, I'm trying not to prejudge where we might come out and what the commissioners might do together, but we're looking at how do we ensure that best execution really means best execution. And right now, we, the SEC, don't actually have a best execution role. It's down at a self-regulatory organization called FINRA. How do we ensure that there's actually competition in that order by order competition, particularly for the segment of the market called retail market orders. And right now, over 90% of those orders are flowing to a small handful of wholesalers and not going to the lit market and not necessarily getting that same competition. So on payment for order flow, it's in the mix, but I don't want to prejudge how things come out. But the goal is really to sort of narrow the costs through greater competition and also trying to better level the playing field.
Yeah. You mentioned order for order competition a couple of times now. So are you going to do a pilot first? Is it going to be for certain types of stocks, or you see something happening across the market?
Again, we're not yet proposing something, but what I've asked the staff to look at is how for retail marketable orders, the bulk of which are just going into this the wholesale market, some of which is through payment for order flow, but the bulk, over 90%, is going to this small handful of wholesalers, is how to get more competition in that space, and potentially through order by order competition. It's also about how to write an SEC level best execution rule around the retail markets, and what has to be taken into consideration in living to that dictum of best execution, putting the client's order first ahead of the brokers.
Can you talk a little bit more specifically about what changes do you want to achieve in best execution? Instead of a FINRA rule, if there's an SEC rule on best execution, what are the pieces that you see being different?
I think there's we have this two-tier system where, and Congress weighed in on this also in something called the Maloney Act in the 1930s. It gets less publicity than the Securities Act and Exchange Act, but FINRA came together originally as a securities dealer association, and they serve a really important function in our capital markets. But the SEC is ultimately the official sector, the cop on the beat, and I think it's important to have a rule on the books, as we do for many broker-dealer rules, where FINRA might be the first line, the first, they do the examinations, they do the compliance checks and so forth, working with the brokers, but the SEC actually has a role. And I think that's really important to ensure that we have the tools at the SEC, but also it's just what information is looked at the time of the actual transaction to ensure that best execution means best execution.
Turning to another really huge market that you're trying to make changes to is the Treasury market, right? And you have several streams of work in that area. Could you talk a little bit about that?
Well, again, stepping back, it's a $25 trillion market. So it's about a quarter of our total US capital markets. It's the base upon which everything else is built. It's really fundamentally a very important market. We all know that. And we've had jitters in this market repeatedly. You and I were studying some of those in the fall of 2020, looking back at the spring of 2020, but in 2019 and 2014 and the like. And so I think that it's two goals: greater competition in the Treasury market and greater resiliency in the Treasury market. And if we needed any reminder about the importance of this, we could just look at the gilt market in the last several weeks. A G7 country, of course, smaller size economy and debt markets, but look at some of the fragility that can even happen in a sovereign debt market of a G7 country. So we have 4 or 5 projects. 2 of them is to get the principal trading firms and the interdealer brokers in this space registered, and frankly, to sort of level some of the playing field. A pro-competitive thing is to ensure that the high frequency traders or principal trading firms in the treasury market are properly registered as dealers, and that the interdealer brokers, the 3 or 4 platforms that stand in the middle, are also regulated and have fair access and the like. Thirdly is central clearing, and central clearing can lower risk in the market, but it also promotes greater access in the market. We put out a proposal working with the U.S. Department of Treasury and the Federal Reserve. We put this out in September. It's out to public comment now. And right now, the cash treasury market's only about, these figures are about a year or so old, but about 13% is centrally cleared. And I think that moving more into central clearing in the cash market and in the treasury repo market is both positive for resiliency, but also is pro competition, because we also included in there things to facilitate customer clearing.
Great. I have a lot more questions on market structure, but I want to make sure I cover the other areas. Let's move to crypto. You have repeatedly said that the rules around crypto are quite clear, but there's a lot of confusion out there. It's not just market participants. It seems like, a lot of bills coming out of Congress trying to figure out which regulator gets what authority. So why is there the confusion if you think it's pretty clear that most tokens...
Just think about this field. It's about 14 years ago, Satoshi Nakamoto wrote her white paper, his white paper. We don't know exactly who she was. So it's a young adolescent, young teenager, 14 years. And the core was a bit, frankly, off the grid. This 8-page white paper was put on a cypherpunk mailing list. It was to try to move value on the internet with no central intermediary, sort of outside of the central bank system, outside of the commercial bank system, and so forth. That foundational bit of it is actually important to your question. At some point in time, somebody determined how to raise money off of this, how to raise money. And we basically had investment contracts in the crypto field. There's about 10,000 tokens. And what is it that the investing public is doing? They're investing in something, hoping for a better future. They're investing in something, anticipating profits based upon the efforts of others. Well, that is, in fact, what the courts have found multiple times, Supreme Court, is the indicia of an investment contract, a security. Congress painted with a broad brush that when the investing public is hoping for a better future, anticipating profits based on others, bingo, that's a security. And so we're trying to work with the market participants, and particularly the intermediaries, the broker dealers, the exchanges, the asset managers. Now, they might call themselves something a little bit different. They might call themselves crypto lending platforms or the like. But if they're handling these tokens, largely speaking, and without prejudging any one of them, they need to come in, register. We've brought enforcement actions, 80 or 90 in the past. We'll continue to be a cop on the beat trying to protect the investing public. But I think, again, largely speaking, these tokens, the public is investing, anticipating profits based upon the efforts of others. Now, there may be a handful, and I really think that it's probably, you can count on sort of the fingers of a hand or two, that don't have that group of entrepreneurs in the middle. It doesn't have the public anticipating profits based upon that there's not the same requirements. And that's where my sibling agency that I was honored to chair, the Commodity Futures Trading Commission, has a really important role as well.
Yeah. So in addition to having people come in and talk to the SEC or enforcement actions, how else can you make it clear that okay, here are the types of tokens that don't fall within our purview. There's so much confusion.
Rena, I just don't accept it. Not liking the answer is not the same as not knowing the answer. And, you teach at Georgetown, you've got great students. I mean, you ask them, wait, when you look, ask for a show of hands, even in that audience there. Is there anybody in the audience that is working with a crypto token project? I'm not going to take names. I'm not going to, right? And do you have a legal contract with them? Do you have an engagement with them? And the answer is going to be generally yes, because you probably aren't working pro bono, and there's some group of entrepreneurs that have signed that contract. It's not. This isn't that confusing, actually. It's pretty straightforward, but people are trying to paper over it, and there's frankly a lot of non-compliance. People are trying to sort of say, well, I set it up in a foundation, or I set it up in another jurisdiction, usually overseas, or I airdropped a few tokens here, but kept most of the tokens myself. But there's a group of entrepreneurs, there's a group of developers in the middle. The hand I saw in the audience, we won't take the name down, probably has a client, and there's somebody there that ought to be thinking, all right, in the US, people are investing based on anticipating a profit and based on our efforts. And the platforms that are trading the tokens, the platforms that are lending, that to work to get inside an investor protection remit.
Yeah. So where do we need legislation from Congress in this whole area? What would you like to see?
So I think, and I've joined together with Secretary Yellen and Chair Powell and my colleagues, the President's Working Group, suggesting that one area is with regard to stable coins. And I'm going to distinguish between two types of coins, but there are coins that are backed by, or purportedly backed by US dollar. There's three large ones, and they're used inside of the crypto intermediaries, inside the crypto system today, about 140, $150 billion of them. Those have a lot of similarities to money market funds. And in a low interest rate environment, weren't necessarily directly paying interest, but often we're giving rewards and yields and other returns. And how to look at that if those particularly moved into the payment system, if they became e-monies. And so we've talked about it at the President's Working Group and the Financial Stability Oversight Council about what's the appropriate safety and soundness oversight on that group of stable coins. There's another group of stable coins that are simply just again similar to what I said earlier. There's a group of entrepreneurs that are saying they have value, and it's the value based upon some algorithm or some efforts of that entrepreneurial group and the like. But even that first group that is purportedly backed by the dollar right now could well be securities, but working with Congress on the safety and soundness side of that, while the CFTC and SEC retain conduct authority. I think the CFTC could well have greater authorities. They currently do not have direct regulatory authorities over the underlying non-security tokens. They have anti-fraud, anti-manipulation, but actual plenary regulatory authority to write rules around the exchanges.
So the Howey test comes up again and again, right? Do you think modifications are needed to the Howey test?
With all respect, no. I think that Congress was right in the 1930s. I think this so-called Howey test that came about with the Supreme Court in 1946 or 7 has been used and upheld by the Supreme Court all the way into the last 15 years, 9 or 10 times. And I think at its core, what and Thurgood Marshall at the Supreme Court wrote in one opinion in the 70s that Congress painted with a broad brush to protect the investing public when sponsors or promoters were trying to take the public's money, hoping for a better future. His words were a little different, but taking that money and promoting something to them. And Congress did this with a lot of knowledge about the incentive systems that promoters and sponsors pumping out an idea and trying to raise money. You need to make sure that there's fair, full, and truthful disclosure. Roosevelt called it the Truth in Securities Act, the 33 Act. That was it. The basic bargain is the same in crypto as it is in other securities. And the vast majority, without prejudging any one of these, the vast majority is exactly what Thurgood Marshall spoke about.
So talking about the Supreme Court, there's been the decision regarding the EPA regulation. How does that change anything that you're doing? And to that, I'll add the lawsuits that are coming against the SEC. Does that slow down your agenda? What do you want to achieve in the next few months that can be reasonably achieved?
Well, let me just step back and say all that we do at the Securities and Exchange Commission is within our authorities as Congress has laid out. And whether they laid it out, as I said, in the 1930s, or even as I said earlier, the competition mandate and authorities that Congress laid out in 1975, 1996, and the like. So we live as an agency within those authorities, and our three-part mission is directed by Congress. But it's also how the courts interpret those authorities. And that's relevant whether it's around insider trading laws or whether it's about proposed rules that we're making. We do economic analysis, and the recent Supreme Court case that you reference is something that we take into consideration. It's the Supreme Court, Rena.
Yeah. Okay. Yeah, no, it is the Supreme Court. So my last question, I have several more, but I want to open it up to questions from the audience. ESG disclosure. What did you hear quickly from the comments, lots of comments that you got, and where are you going with it?
Well, we got between 14 and 15,000 comments. The comment periods, I think, reopened again. We reopened some of the comment periods. So please, the listening audience, send in further comments. I would say that generally there's a lot of support, but also the details really matter. Look, this is a conversation already going on. Back to that basic bargain of the 1930s and that Thurgood Marshall later wrote about, is that investors get to decide, but they want full, fair, and truthful disclosure about those issuers. And part of the risks that investors are today considering relates to climate risk. And what is that? That's the fiscal and transition risk of the path forward in the markets. It's about customers, it's about competitors, it's about supply chains, it's about potential regulatory treatments or new laws and the like. So it's those transitional features. And we've heard from investors probably representing well over $50 trillion of assets. When you add up all the assets that are managed by all the commenters, $50 to $60 trillion of assets, generally wanting to have greater consistency, comparability, and decision usefulness around this. But then the details matter. It's going into the particular details. We tried to build off of a framework that many companies are already using. Hundreds and hundreds of issuers already do disclosures, trying to build off of those. But naturally, we benefit from those comments. We make adjustments, we make modifications based upon those comments. I can't prejudge it. We also look to do within our authorities and our authorities as interpreted. And as you mentioned earlier, there was this new ruling in June, West Virginia versus the Environmental Protection Agency. And so that's significant and meaningful, and we look at it within those rulings as well.
Okay. Fantastic. I could go on and on, but I want to make sure we get some questions in. And please come on to the mic. We have some students who want to ask you questions. So I'm going to give them the first go at it, please.
Good morning. Thank you so much. You touched on this a little bit already,
And
but
what's your first name?
Sinskriti. I'm a third year in the MSB here.
All right.
Rina's actually my professor in this coming second half of the semester.
She's great.
So there have been concerns that the ESG disclosures are motivated by factors outside of the SEC's administrative mandate. You touched on this a little bit, but why do you see these disclosures as crucial to maintaining fair markets?
It's a great question. Our remit is an important one, but it is narrow. It's a disclosure based related to what investors are making their investment decisions. And some people also point to materiality, which again, back to the Supreme Court, has been defined a number of times about what, in essence, what's a substantial likelihood that a reasonable investor would find the information significant in the total mix of information. And so it's through that lens. And currently in 2022, investors, again, representing 50 to 60 trillion dollars of assets. And it's not just because you added up 4 or 5 big asset managers. I mean, thousands and thousands of investors have written in and said, we are making investment decisions based upon these risks and the disclosures currently are quite fragmented. They're different. And so in terms of fair dealing, you mentioned, is to bring some consistency to that so that lowers cost in the system as well, to bring some consistency, but also some fairness there in that. We are not, though, an agency that has something to do with whether greenhouse gas emissions are going up or down. In fact, better capital markets and better capital market pricing and information might lead to somebody going long a risk or short a risk. They might be thinking that they want to go long green or short green. And so it could go either way. That's not our remit. Our remit is much narrower. We're not merit-based, we're disclosure-based. I think I can take one more.
Sure. Please introduce yourself.
Right. Good morning. My name is Robert Fanchulo, and I'm a senior here in the undergraduate business program at Georgetown. In light of your previous comments about best price execution in public equity markets, what policies do you see the SEC adopting in the future? Does this mean requiring exchanges to make changes, such as those the IEX exchange made? Or does this mean increasing transparency for dark pools? Thank you.
So I don't know what we'll adopt because we're a 5-member commission. We've got to go through this notice and comment economic analysis. But what I've asked staff to work on and what I think is really important is to bring more transparency when depending upon the day of the week and the markets we're in, between 35 and nearly 50% of the market is in, as you called it, the dark markets, going to wholesalers off exchange, going to alternative trading systems. There's not a level playing field across exchanges, what's called ATSs and the wholesalers, and trying to bring some harmonization to something as fundamental as minimum pricing increments called tick sizes, trying to, as I said, have the SEC have a best execution rule, looking at what's something called access fees. So there's a lot of details that really do matter, but it's trying to bring greater transparency and competition to this important part of our capital markets. Rena, I want to thank you especially for rolling this a little earlier because of the various meetings that I've got to get to and with the IMF World Bank meetings and so forth. So I really do appreciate your accommodating my schedule as well. And maybe in the future, I'll be able to be back in that grand auditorium there.
Yeah, we would be delighted to have you back, and thank you so much for joining us. And we will make the recording available for those who missed it. Yeah, thank you, Garrett.
Thank you.